The air crackles with uncertainty. The economy, once a roaring engine of prosperity, sputters and coughs. News headlines scream about rising inflation, a volatile stock market, and the looming threat of a recession. Fear, like a virus, begins to spread, infecting the minds of consumers and investors alike. Is this just a temporary blip, a bump on the road to economic recovery? Or are we facing a more ominous reality, a deep dive into the abyss of recession? In times of economic uncertainty, it's natural to seek guidance, to look for answers from those in positions of power and influence. One such figure who continues to command attention and shape narratives is former President Donald Trump. His pronouncements on the economy, often delivered with his signature blend of bravado and bluntness, have a way of shaking things up, of sending ripples through the markets and the media. Trump's pronouncements on the economy carry weight, not just because of his former position as president, but also due to his carefully cultivated image as a business tycoon. When he speaks, people listen, especially when his words tap into existing anxieties and fears. In a recent interview, Trump didn't mince words. He stated bluntly that he believes the United States is in a period of transition and that a recession is possible this year. This isn't the first time Trump has made such predictions, but the timing of his latest pronouncements, coupled with the current economic climate, has given his words an added sense of urgency. Trump's comments, as is often the case, have been met with a mixture of derision and concern. Critics are quick to point out that his track record on economic predictions is far from perfect, accusing him of fear-mongering for political gain. Supporters, on the other hand, view his statements as a dose of hard-hitting truth, a wake-up call to a nation teetering on the brink of economic turmoil. Regardless of one's political leanings, it's impossible to ignore the impact of Trump's words. When someone with his platform and influence makes a statement about the economy, it reverberates, sending shockwaves through the markets and the media. The stock market, that fickle barometer of economic sentiment, reacted to Trump's pronouncements with predictable volatility. As news of his comments spread, stock prices dipped, sending a ripple of anxiety through the financial world. Investors, always attuned to whispers of uncertainty, reacted swiftly, adjusting their portfolios and bracing themselves for potential turbulence. The Dow Jones Industrial Average, that bellwether of the American stock market, shed hundreds of points, reflecting the jitters that gripped Wall Street in the wake of Trump's pronouncements. Other major indices, including the S&P 500 and the Nasdaq Composite, also experienced declines, as investors reassessed their positions and sought to mitigate their risk. While the stock market's immediate reaction to Trump's comments was undeniable, it's important to remember that the market is often driven by emotion, by fear and greed, as much as by rational analysis. Short-term fluctuations, while unsettling, don't always reflect the underlying strength or weakness of the economy. Nevertheless, the market's response to Trump's pronouncements serves as a stark reminder that words have power, especially when uttered by influential figures. When it comes to the economy, perception can often become reality, as fear can be self-fulfilling, leading to a downward spiral of reduced spending, investment, and economic activity. Let's revisit the crux of Trump's recent economic pronouncements, the words that sent chills down the spines of investors and sparked a flurry of anxious headlines. "We're going to experience a period of transition," Trump declared, his tone a mix of matter-of-fact observation and ominous foreboding. The former president, never one to shy away from bold statements, didn't stop there. "A recession is possible," he added, the words hanging in the air like a dark cloud threatening to unleash a storm upon an already uncertain economic landscape. These pronouncements, delivered with Trump's characteristic blend of confidence and ambiguity, ignited a firestorm of speculation and debate. What exactly did he mean by transition? How severe a recession did he envision? And perhaps most importantly, what evidence, if any, did he have to support his claims? The ambiguity of Trump's pronouncements, while frustrating to some, is arguably part of their power. By leaving his statements open to interpretation, he allows individuals to project their own fears and anxieties onto his words. For those already inclined to believe that the economy is headed for a downturn, Trump's words serve as confirmation of their worst fears. On the other hand, those who view the economy through a more optimistic lens may dismiss Trump's pronouncements as nothing more than political posturing, an attempt to sow discord and undermine confidence in the current administration. The truth, as is often the case, likely lies somewhere in between these two extremes. To grasp Trump's economic pronouncements, we must deconstruct his rhetoric. Trump uses hyperbole and simple, declarative sentences to sway public opinion. His exaggerations grab attention but obscure economic complexities. This strategy mobilizes his base but can deepen divisions. In today's interconnected world, words have the power to move markets and shape perceptions. Trump's economic pronouncements send ripples through the global financial system. The stock market reacted with predictable volatility. Investors adjusted their portfolios, hedging against uncertainty. The Dow Jones experienced a noticeable dip. The market is driven by emotion as much as by rational analysis. Short-term fluctuations don't always reflect the economy's strength. Words have power, especially from influential figures. Trump's pronouncements extend beyond Wall Street. Talk of recession impacts consumer spending habits. Fear and uncertainty highlight the importance of responsible rhetoric. Donald Trump wields uncertainty like a seasoned card player, keeping opponents guessing and followers in anticipation. His economic pronouncements inject ambiguity, shaping narratives and controlling debates. This climate of fear can erode confidence and create a yearning for stability. However, it risks a self-fulfilling prophecy of economic turmoil. The financial world, for all its claims of rationality, often behaves more like a skittish thoroughbred than a calm, calculating machine. A sudden noise, an unexpected shadow, even a whisper of uncertainty can send it bolting. This volatility was evident when Donald Trump offered his latest economic forecast, hinting at a possible recession. Wall Street reacted swiftly. Stock prices reversed course abruptly. The Dow Jones shed hundreds of points. Other indices, including the S&P 500 and NASDAQ, followed suit. This phenomenon, often dubbed the Trump tumble, highlights his unique market-moving ability. While the stock market's knee-jerk reaction to Trump's pronouncements is readily apparent in the plummeting price of indices, there's a more nuanced way to gauge the level of anxiety coursing through the veins of Wall Street. The CBOE Volatility Index, better known by its ticker symbol VIX, often referred to as the Fear Index. The VIX measures the market's expectation of future volatility, essentially quantifying how much prices are expected to swing up or down in the days and weeks ahead. As Trump's comments about a transition and a possible recession reverberated through the financial world, the VIX shot up like a rocket. This surge indicated that investors were not only reacting to the immediate news but also bracing themselves for a period of heightened uncertainty, a roller coaster ride of market fluctuations as they attempted to decipher the implications of Trump's words and their potential impact on the real economy. The VIX, while often viewed as a barometer of fear, can also be interpreted as a measure of the market's need for information, for clarity. When faced with ambiguity, with pronouncements that raise more questions than answers, investors tend to price in a higher risk premium, demanding greater returns to compensate for the elevated uncertainty. This is reflected in the VIX, which essentially acts as a real-time gauge of the market's collective anxiety level. It's important to note that the VIX, like any other market indicator, is not a perfect predictor of future volatility. It reflects sentiment, expectations, and sometimes even self-fulfilling prophecies. Nevertheless, its sharp rise following Trump's comments provides valuable insight into the psychological impact of his words, underscoring the power of rhetoric, especially when delivered by a figure who has repeatedly demonstrated his ability to disrupt the status quo. The CBOE Volatility Index, or VIX, measures Wall Street's anxiety. Often called the Fear Index, it gauges expected market volatility. Trump's comments spiked the VIX, reflecting heightened uncertainty and the market's need for clarity. When uncertainty howls through Wall Street, investors adjust their course. They steer towards safe havens like gold and U.S. Treasury bonds, seeking stability. Riskier assets like tech stocks and emerging markets often see sell-offs. Investors' reactions vary, but the instinct to protect remains constant. Section 4. Beyond the panic deciphering the market's message. The stock market's reaction to Trump's pronouncements caused panic selling and volatility. But is Wall Street genuinely concerned about a recession, or just pricing in higher risk? The U.S. economy remains strong with low unemployment and robust consumer spending. The Federal Reserve is committed to combating inflation, even if it slows the economy. Wall Street's reaction suggests a nuanced assessment, not impending doom. Investors seek clarity and reduced uncertainty. Until then, expect heightened sensitivity to economic news. Section 1. Recession 101. Decoding the economic jargon. Amidst the cacophony of economic news, the word recession echoes ominously, conjuring images of job losses and market crashes. But what exactly does it mean for an economy to experience a recession? Let's peel back the layers of jargon and demystify this phenomenon. A recession is a significant decline in economic activity lasting more than a few months. The National Bureau of Economic Research defines it as a decline visible in GDP, income, employment, and sales. So the next time you hear the R word, remember it's a complex determination by economists. Section 2. The anatomy of a recession: causes, symptoms, and consequences. Recessions, like illnesses, can manifest in different ways, with varying degrees of severity and duration. However, beneath the surface of each unique economic downturn lies a common set of causes, symptoms, and consequences that provide insights into the inner workings of these economic maladies. The causes of recessions are as varied as the economies they afflict. Sometimes, they're triggered by external shocks, such as a sudden spike in oil prices, a global pandemic, or a financial crisis in a major economy. Other times they arise from internal imbalances, such as excessive debt levels, asset bubbles, or a loss of consumer confidence. In many cases, it's a combination of factors that conspire to tip the economy into a recessionary spiral. The symptoms of a recession are often all too familiar: rising unemployment, declining consumer spending, falling business investment, and a shrinking gross domestic product. These economic indicators, like vital signs in a patient, provide clues to the overall health of the economy and its trajectory. As a recession deepens, these symptoms become more pronounced, creating a vicious cycle of economic decline. The consequences of a recession can be far-reaching, impacting individuals, businesses, and governments alike. For individuals, a recession can mean job losses, wage cuts, and a decline in living standards. Businesses face declining sales, reduced profits, and increased bankruptcies. Governments grapple with falling tax revenues, rising budget deficits, and the need for costly stimulus measures to revive the economy. While the word recession often evokes images of economic devastation, it's important to remember that not all recessions are created equal. Like storms, they can range in intensity from mild downturns that are barely noticeable to severe contractions that leave lasting scars on the economic landscape. Economists often categorize recessions based on their severity, duration, and underlying causes. A V-shaped recession, for example, is characterized by a sharp decline followed by an equally rapid recovery. A U-shaped recession involves a longer period of economic contraction and a slower, more gradual return to growth. An L-shaped recession is the most dreaded of all, marked by a steep decline followed by a prolonged period of stagnation, with little or no growth for years. The causes of a recession can also influence its severity and duration. A recession triggered by a financial crisis, for example, tends to be more severe and longer-lasting than a recession caused by a temporary shock, such as a natural disaster. Similarly, a recession that coincides with structural imbalances in the economy, such as excessive debt levels or a misallocation of resources, is likely to be more difficult to recover from than a recession that occurs in a relatively healthy economic environment. Understanding the nuances of recessions their different shapes, causes, and consequences, is essential for policymakers, businesses, and individuals alike. It allows for more informed decision-making, more effective policy responses, and a greater appreciation for the cyclical nature of economic activity. If there's one thing that economists excel at, it's disagreeing with each other. Predicting the economy often feels more like reading tea leaves than analyzing data. Recessions, like earthquakes, often strike without warning, defying even the most astute prognostications. The complex interplay of factors like consumer confidence, business investment, and global events makes precise modeling difficult. The economy is a dynamic system, influenced by many unpredictable factors. The best we can do is stay informed and make prudent decisions to weather economic storms. History offers valuable lessons for those willing to listen. Just as a mariner consults charts, we can learn from past economic upheavals. By studying recessions and crises, we gain insights into economic cycles and human behavior. From the tulip mania in Holland to the South Sea bubble in England, from the Great Depression to the 2008 financial crisis, history is full of economic booms and busts. Each episode offers lessons about markets, foresight, and policy. Studying the past helps us make informed decisions today. To understand future recessions, we must revisit past ones. The Great Inflation of the 1970s and the Great Recession of 2008 offer valuable lessons on economic policy and the dangers of unchecked speculation. The COVID-19 pandemic delivered a once-in-a-century economic shock, the likes of which had not been seen since the Great Depression. Unlike previous recessions, the COVID crash was a direct result of a global health crisis, forcing governments to take unprecedented measures. The economic impact was swift and severe. Global supply chains halted, consumer spending plummeted, and businesses shuttered their doors. Yet, amidst the economic carnage, there were glimmers of hope, testaments to the resilience of the human spirit. Businesses embraced e-commerce, remote work, and contactless delivery, accelerating trends already underway. Governments unleashed massive fiscal and monetary stimulus packages, providing a lifeline to struggling businesses and individuals. The COVID crash, while a period of immense hardship, also served as a crucible, forging new ways of working, consuming, and interacting. It accelerated digital adoption and highlighted the importance of social safety nets. The lessons learned will shape our economic landscape for years to come. Economies swing like pendulums between expansion and contraction. Booms bring growth and prosperity, but can lead to overinvestment and bubbles. Busts clear excesses, fostering efficiency and innovation. Policymakers aim to balance these cycles for sustainable growth. As the specter of a recession looms, it's natural to feel a sense of unease. Taking proactive steps to strengthen your financial position can provide control and peace of mind. Build an emergency fund to cover essential expenses for several months. This fund helps navigate disruptions without resorting to high-interest debt. Examine your spending habits and create a budget. Differentiate between needs and wants to free up cash flow for savings, debt reduction, or investments. Preparing for a recession is about making informed choices, ensuring your financial house is in order to weather economic storms. When recession fears grip the markets, it's easy to get caught up in the frenzy of selling. However, history teaches us that panic selling is rarely a winning strategy. Instead, approach market turbulence with prudence. Remember, the stock market often prices in future conditions months in advance. Stay focused on long-term goals and avoid emotional decisions. Seek guidance from a qualified financial advisor if needed. Navigate the ups and downs with a calm mindset. Emerge with your financial well-being intact. Recessions, while often viewed as periods of economic hardship, can also be catalysts for innovation, adaptation, and personal growth. Just as a tree bends with the wind to weather a storm, so too can individuals and businesses navigate economic downturns by embracing flexibility, resourcefulness, and a willingness to adapt to changing circumstances. In the workplace, a recession can be an opportunity to acquire new skills, expand your professional network, and explore alternative career paths. Consider taking advantage of online courses, professional development programs, or industry certifications to enhance your marketability and position yourself for success in a competitive job market. If you're facing job insecurity, explore alternative work arrangements such as freelance opportunities, consulting gigs, or part-time positions to supplement your income and maintain a steady cash flow. This period of economic uncertainty can also be an opportune time to revisit your long-term career goals and consider whether a career change or entrepreneurial pursuit might align with your evolving aspirations. Remember, a recession is not a time to retreat into fear and inaction. It's an opportunity to embrace change, to tap into your creativity, and to emerge stronger and more resilient on the other side. By adopting an attitude of adaptability and a willingness to learn and grow, you can not only survive a recession but thrive in the face of economic adversity. Recessions, while often viewed through a lens of fear and uncertainty, can also be periods of profound transformation, both for individuals and for society as a whole. Just as a forest fire, while destructive, clears away deadwood and allows new growth to flourish, so too can an economic downturn create the conditions for innovation, renewal, and a reimagining of what's possible. Throughout history, periods of economic hardship have often been followed by bursts of creativity, as individuals and societies alike are forced to rethink old assumptions, challenge conventional wisdom, and explore new ways of doing things. The Great Depression, for example, gave rise to the New Deal, a sweeping set of government programs that transformed the role of government in American life and laid the foundation for the social safety net we know today. The dot-com bust of the early 2000s, while initially devastating for many, paved the way for a new wave of internet innovation, as entrepreneurs learned from the mistakes of the past and laid the groundwork for the social media giants, e-commerce platforms, and cloud computing services that dominate the digital landscape today. The COVID-19 pandemic, while a period of immense hardship and loss, also accelerated the adoption of digital technologies, reshaped the nature of work, and forced us to confront systemic inequities that had long been ignored. As we emerge from this global crisis, we have an unprecedented opportunity to rebuild our economy and our society in a way that is more equitable, sustainable, and resilient. As we stand at this economic crossroads, bombarded by conflicting signals, it's easy to feel disoriented in a sea of uncertainty. Former President Trump's recent pronouncements about a looming recession add to the unease, injecting political rhetoric into an already complex environment. While it's impossible to predict the future, we can navigate these crosscurrents with clarity and purpose by grounding ourselves in history, sound financial principles, and skepticism towards fear-mongering pronouncements. In times of economic uncertainty, it's easy to feel powerless, like a ship tossed about by forces beyond our control. However, we can choose how we respond. Embrace preparation and perspective. Take proactive steps to strengthen your financial position and recognize opportunities for growth. Transform fear into action and uncertainty into opportunity. The economic horizon may be shrouded in mist, the pronouncements of politicians may echo with uncertainty, and the daily news cycle may be filled with tales of economic woe, but amidst this turbulence there is also opportunity. The opportunity to take control of your financial destiny, to invest in your future, and to emerge from this period of economic uncertainty stronger, wiser, and more resilient than ever before. This is not a time for complacency, nor is it a time for despair. It's a time for action, for informed decision-making, and for a renewed commitment to the values and priorities that truly matter. It's a time to tune out the noise, to cut through the hype, and to focus on what you can control, your own actions, your own choices, and your own response to the challenges and opportunities that lie ahead. So, chart your course with care. Build your financial fortress, navigate market turbulence with prudence, embrace the art of adaptation, and never lose sight of the opportunities that lie hidden within every challenge. Remember, the economy is not a force of nature to be feared, but a human creation to be shaped, molded, and ultimately mastered. The future is not something that happens to us, it's something we create, one informed decision, one prudent investment, one act of courage at a time.